In this section, we shift from can we do on-chain payments to can we run them safely at scale. You'll see how operational risk changes on-chain, what custody models really mean in practice, and which controls risk teams expect before they'll sign off on a pilot. In traditional payment operations, you live in a world of reversibility. If something goes wrong, you can recall funds, push a chargeback, or ask an intermediary bank to unwind the transaction. Most controls and disputes happen after the payment is sent. On-chain, that mindset flips. Once a transaction is confirmed, it's essentially irreversible. So risk, fraud, and compliance controls must move to the front of the flow before you hit send, because there is no reliable recall button. When you move cross-border payments on-chain, most serious incidents cluster around three threat vectors. First, private key compromise. If an attacker gains control of a key, they effectively own the assets. This is why institutional-grade custody, access controls, and hardware security are non-negotiable. Second, smart contract or integration failure. A bug in code or a broken connection to legacy systems can freeze or misroute funds at scale. Third, human operational error. Misconfigured limits, wrong addresses, or manual workarounds can defeat even excellent technology. In traditional finance, keys and passwords are just access tools. If someone steals your badge or login, security can disable it, reset your password, and restore control of the underlying account. With cryptographic keys, the key is the asset. Whoever controls the private key can move the funds, and the network will honor that, no questions asked. So key compromise isn't an inconvenience, it's final. There's no help desk, no chargeback, and no reset button on-chain. When you move cross-border payments on-chain, your code effectively becomes part of the critical payment infrastructure. The smart contract core isn't just business logic, it's the new settlement engine. That introduces smart contract risk. A bug, a flawed upgrade, or a dependency like a stablecoin contract can halt or misroute value. Around that engine, every API between wallets, banking systems, and blockchain nodes becomes an integration risk. A single version mismatch or protocol upgrade can instantly break a live corridor end-to-end. On-chain, human mistakes suddenly become final in a way you're not used to. A single wrong character in an address or choosing the wrong network can mean funds are effectively gone, with no recall, no ops ticket, and no correspondent bank to phone. This raises the bar. Operational teams need airline-level precision, strong controls, and UX guardrails to protect against everyday human error. Custody choices sit on a spectrum between regulatory comfort and technical control. At one end, a fully outsourced custodian shoulders most regulatory burden and operational complexity. You gain strong, battle-tested processes, but you surrender direct key control and depend on that provider's uptime and playbook. As you move toward tech-only, hybrid, and finally self-custody, you gain configurability and speed of response. But you also inherit more compliance work, more integration effort, and ultimately full liability if something goes wrong. Once an institution controls large amounts of digital assets, a single private key becomes a huge liability. Multi-signature and MPC are two ways to spread that risk. Multi-sig requires several independent keys to approve a transaction. MPC goes further by mathematically splitting one key across different parties, so no one ever holds it whole. Both approaches aim to remove single points of failure in key management. Think of your institutional wallet like a vault with three concentric defenses. At the outer layer, you slow things down. Policy limits, velocity checks, and high-value caps that catch fat finger mistakes and obvious abuse. Inside that, you enforce segregation of duties, so no single person can initiate, approve, and reconcile the same payment. At the core, you restrict where value can go with tight address whitelisting. Together, these cryptographic controls replace ad hoc checklists with enforceable code-level safeguards. The next layer is about proving your books match the chain all the time. Think of it as a reconciliation mirror. Every on-chain balance and movement must have a clean, auditable twin in your internal subledgers. Instead of manual ticking and tying, you wire in Block Explorer APIs and node data. They feed automated exception reports that flag timing gaps, missing entries, network fees, and rounding noise before they become real breaks. At this layer, you assume something will go wrong and design how you'll respond before it happens. You define clear playbooks for key compromise, missent funds, or a contract that must be frozen quickly. You also plan vendor contingencies, who you fail over to if a node provider or custodian goes down, and how you resync once they're back. And you set escalation paths so legal, regulatory, comms, and executives know exactly when and how to engage. A strong institutional risk register treats every risk as a pair, a scenario and a control. You map each scenario by likelihood and impact, then attach one primary control you can measure. Private key theft might be mitigated with MPC wallets and strict signing policies. Missent payments to the wrong chain get paired with address whitelisting and root validation. Node outages or reconciliation breaks linked to monitoring and automated API checks. This mindset turns abstract blockchain risk into a concrete, trackable control framework. On-chain payments force a different operational mindset. On traditional rails, if something goes wrong, you fix it after the fact with recalls, adjustments, and manual overrides. On-chain, execution is closer to firing a bullet. Once it's confirmed, it's final. So your focus shifts to airtight pre-checks, automated controls, and continuous monitoring. You trade reversibility for stronger math-based defenses.